Stop checking the price chart every 5 minutes. Stop sending panic texts to your friends asking what just happened. Stop watching analysts on television who have not looked at a COMEX vault report in their entire career. Your silver is safe, your physical position is safe. But this one number, this single coverage ratio, that is a crime scene, and the people being paid to explain it to you are pretending it does not exist. Today is March 20th, 2026. In 6 weeks, the May COMEX delivery cycle reaches its deadline. That is the moment paper contracts become real obligations, when a trader holding a paper promise must either deliver actual physical silver or pay cash and walk away. And right now there is not enough physical silver to honor even a fraction of those promises. In 1980, the last time this setup existed, silver moved from $6 to $49. Not over 20 years, not over 10 years, 18 months. What I am about to show you is the same signal showing up again, right now. COMEX registered silver, 76.88 million ounces. That is the physical metal in vaults that can actually be delivered tomorrow. COMEX open interest, 575.5 million ounces. That is the paper, the promises, the contracts, the digital claims existing on screens right now. Divide 76.88 by 575.5. You get 13.4%. That is the share of paper contracts that real silver can actually back. For every single ounce of physical silver available for delivery, there are 7.5 paper tickets claiming it. 7.5 per ounce. In dollar terms, registered silver equals $6.12 billion in real metal. Paper exposure equals $45.8 billion in printed promises. This is a bank with $1,000 in the vault and $7,000 in withdrawal slips already handed to the public. And COMEX has defined 15% as the stress threshold, the level below which the system is under structural pressure. COMEX has now been below 15% for 6 consecutive weeks, not once recovering, not once improving. Let me repeat that, 6 weeks in a row, below the danger line. Now I need to introduce you to the institution running this operation, JPMorgan. In 2025, JPMorgan paid a $267 million fine for spoofing silver futures, placing fake orders to move the price in whatever direction they needed, then canceling before execution. They did this from 2009 to 2019, a decade, and the penalty was less than 2 weeks of profit. Right now, JPMorgan and their allied bullion banks hold a net short position of 212 million ounces on COMEX silver. They are betting against silver on paper, while real silver disappears from real vaults in real time. That is not a hedge, that is a strategy. Here is what JPMorgan says publicly. Cash settlement makes delivery risk negligible. 13.4% coverage is a technical quirk. The market is functioning normally. Here is what 200 million ounces of silver leaving COMEX vaults since mid-2025 says. The market is not functioning normally. 200 million ounces more silver than the entire United States produces in 3 full years, gone from exchange vaults in 9 months. Gold silver, Com called it the steepest drawdown in any comparable period in recorded history. They say no systemic risk. The vaults say 200 million ounces missing. Reconcile those two things in your head. And while you do understand that JPMorgan holds 212 million ounces net short on paper to hold the price down, while quietly accumulating physical silver outside COMEX-linked systems, one statement for you, one action for themselves. This is the definition of playing both sides of the table. Now let me show you the physical evidence, and this is where it becomes impossible to dismiss. Investing.com, April 17, 2026, reports 76.88 million ounces registered against 575.5 million in open interest. The first-time coverage has stayed below 15% for 6 consecutive weeks, with a delivery cycle warning attached. CME Group official warehouse data, April 13, 2026. The raw unedited numbers registered at 76.88 million, open interest at 575.5 million, confirming everything. Finance magnates, April 6, 2026, independent financial media explicitly calling this stress territory and framing it as a bullish signal. Shanghai Futures Exchange, March 2026, silver trading at a 12 to 13% premium over COMEX, physical buyers in China paying more for real metal than the Western paper price suggests it is worth. And then there is Binance, the largest crypto exchange on Earth. Their research desk published a full report on COMEX silver inventory pressure, describing the 13.4% coverage as a pressure zone. Binance, analyzing silver vaults. Let that sentence sit for 1 second. When the crypto world starts tracking physical precious metals inventory, the signal is loud enough that nobody can ignore it anymore. Now stop. Before I show you the last source, I want you to think about one thing. If the paper market is fine, if 13.4% coverage is just a technical quirk, then why is Shanghai paying a 12 to 13% premium to buy the exact same metal that COMEX says is sitting comfortably in its vaults? If supply is fine in New York, Why is China paying more to get real silver right now? Think about that for 3 seconds, because the answer to that question explains everything. Gold silver. April 15, 2026. Net withdrawals from COMEX depositories total approximately 200 million ounces since mid-2025, the steepest drawdown in any comparable period in recorded history. Bloomberg Metals research now explicitly references physical supply tightness, 6 consecutive annual deficits, and rising premiums in Shanghai and India as a structural concern. Bank of America Metals notes, the same Bank of America that told you everything was fine in 2007, right before the housing market collapsed. Those notes now use the phrase asymmetric upside risk in private client briefings. Asymmetric upside risk. That is what a bank calls something when they want to tell their wealthy clients to buy, without actually saying the words "buy this now" on paper. These are the same institutions whose trading desks sit on the short side of COMEX silver. Public face no systemic risk. Private client notes, structural deficit, physical tightness, asymmetric upside. One statement is for retail investors watching YouTube. The other is for clients managing hundreds of millions of dollars. You now know which one is which. In 1979, COMEX silver coverage was similarly stretched, paper longs exploding, physical supply bleeding from vaults. Silver moved from $6 to $49 in 18 months. Not over 50 years, not over 20 years, 18 months, a 500% move born from the same structural setup you are watching right now. The people who ignored that signal waited for mainstream confirmation, which came when silver was already at $49 and falling. By the time the headline said silver is exploding, the explosion was over. Silver right now is a coiled spring. 6 consecutive years of supply deficits, 762 million ounces drawn from global stockpiles have compressed it. A 7.5-to-1 paper-to-physical ratio has compressed it further. 6 weeks below the stress threshold has compressed it further still. The spring does not care when it releases. It does not announce itself. It does not give you a second chance. It simply releases, and anyone not already positioned watches the move happen without them. Right now there are 3 realities operating simultaneously. Reality 1, the paper market says silver is priced at whatever COMEX prints, 232,242 net short contracts holding the number down with keystrokes. Reality 2, the physical market says something completely different, Shanghai paying a 12 to 13% premium, 200 million ounces gone from vaults since mid-2025, coverage at 13.4% for 6 weeks and not recovering. Reality 3, these 2 realities cannot coexist indefinitely. One resolves the other. History says it is never the physical market that blinks first. You have 3 choices. Believe the paper market, do nothing and wait for mainstream confirmation that arrives after the move. Or follow the physical evidence, track the vault data, watch the coverage ratio, position before the paper market is forced to reflect what the physical market already knows. Only one of those choices has worked in every historical parallel. Do not take my word for any of this. Check the CME Group Daily Metal Stocks Report. Public data updated every trading day. Look at registered silver, look at open interest, do the division yourself. Track the Shanghai Futures Exchange silver premium over COMEX reported daily, currently 12 to 13% against a normal range of 0 to 2%. Read the investing coverage ratio analysis from April 17, 2026. Read the Finance Magnates piece from April 6. Read the goldsilver.com report on the 200 million ounce withdrawal. Every number in this video is sourced, dated, and verifiable in 30 minutes. The evidence does not require my interpretation. It speaks by itself. If you are holding physical silver right now, if you bought that metal with cash you do not need tomorrow, this video has not changed your position. It has confirmed it. You are not the person getting a margin call. You are not the trader watching a leveraged position liquidate. JPMorgan is running a 212 million ounce short against an inventory of 76.88 million ounces of real silver, against 6 years of structural deficit, against a market draining 200 million ounces in 9 months. They are not winning this fight. The math will not let them. The physical market has never, not once in recorded history, permanently lost to a paper short position. You are on the right side of this trade. Stay there. The paper market lies. The physical market does not. The vaults are telling you the truth. Follow the vaults. Drop a comment below. Are you holding physical, or did the paper volatility shake you out? I want to know where you stand. This is Financial Joe Alert. Track the vaults. Trust the data. The paper price is always the last thing to move.